What is going on, everyone, and welcome to the channel. So we're going to be talking about how to trade options on Robinhood, and this is going to be an updated video going over the current platform and currently how to do this. As platforms change, I'll be updating videos like this in the future and making future updates. But here we are right now. So how to trade options on Robinhood. I want to go through them and have some timestamps below this video. So make sure you check out those timestamps if you have a specific area that you have a question on. We're pretty much going to be going over the basics of how to do it initially, and then we're going to dive into the actual Robinhood platform here on the right hand side so you guys can get a sense of how this is done live. Now, it's actually pre-market the time I'm filming this video, so when it's pre-market you can't actually execute or purchase options or buy contracts, sell contracts. You can only do that from 9:30 a.m. to 4 p.m. Eastern time during regular market hours. That's how options, and that's when options are traded. So just because Robinhood may have extended hours trading or other brokers have extended hours trading, that does not mean that you could trade options during those hours. You can trade stocks, but not options. So going along, so the introduction I want to talk about here is we have something called calls and we have puts. So calls, you believe the stock price is going to go up. That's why you would buy a call, and a put is if you're betting on the stock to go down. So think of it as if you're making a bet, either up or down. Now, when you're making an option play or you're making a bet, or when you buy a stock, you're almost making a bet in the same way. Either you're playing it or you're holding it for a dividend, or you're holding a stock to go up, or you're shorting a stock to go down. Same thing, except options are more volatile and you can make more money on a smaller percentage move in the underlying stock. Now, a lot of factors go into that, which we're going to be diving into here in this video. So when you purchase a call or a put, you have the right, not the obligation, but you have the right to purchase or sell 100 shares at the strike price, and that is for one contract. So when we go through the order form here on the right hand side of Tesla, we talk about trading Tesla options on the right hand side, which we'll do here in just a second. When you put in one contract, that's for 100 shares, for the right of 100 shares. And at a given strike price, you're buying that right for those 100 shares per one contract by the expiration date. And so there'll be expiration dates and there'll be dates sorted. And so if you're not sure what that means, those are the expiration dates. That's the date the option expires, where you either need to sell it beforehand or you can execute the option. Now, most people will not be executing, so I want to make that very, very clear. If you're looking to trade options, you heard from somebody, you heard from a friend, or you're looking to make money on trading options where you can make more percentage gains, right, in a smaller percentage move in an underlying stock, you're looking to trade the premium, which is at the bottom right here. So you're going to be buying and selling the premium. So the idea that you really want to play here is you're buying the premium at, let's say, $1, and you're trying to sell that premium for more before the expiration date. Now, it's very, very common where if you can buy a premium for, let's say, $1, it's very, very common to be able to sell that for $2, $3, and sometimes significantly more, even if the stock just moves a couple percent or 1 or 2%. And if we think about that, you're going to 2, 3, 4, 5x your money. And that's the power of options trading. The next thing we want to talk about here is in versus at versus out of the money. So you're going to see things like ITM, ATM, or OTM. What do those things mean? Well, there it is. So let's now talk about what this actually means by showing you an example, because that's the best way to kind of go over this. So I'm going to click Trade Tesla Options. Now, really quick, if you guys don't know what this is, so you have a Robinhood account, there's a link down below to get signed up and create an account. So you go to the search and you can type in any ticker you want. So for example, you can type in the name of the company or the ticker symbol if you know it. So it's TSLA for Tesla. We come to a page that's going to look like this. Then you click on the right-hand side, Trade Options. On mobile, it's going to be pretty much the same thing, very, very similar layout, just on your mobile device. Then you're going to come to a page that looks like this. So we have buy, we have sell, we have calls and puts. So primarily this video is going to be going over buying calls and puts. I have some other videos explaining what selling calls and puts are. They're a little more advanced. So check those out here at the end of the video if you guys have any questions on that, and I can make a more in-depth video of how that works going forward, but most people are going to be concerned with just buying calls and puts. So this is a very inflated option premium because I actually have the expiration date fairly far out, a couple months out from when I'm filming this video, but it's pretty much going to be the same thing. So the right-hand side, we have the price, which is the premium. We're going to have to click on these and go a little bit more into depth, but we currently have the share price, and so what I want to explain is what the in the money, out of the money, at the money means. So At the money is probably the easiest thing. We currently are not at the money. So at the money means the share price is at the strike price, okay? Now, this is going to change, but let's say you're looking at the $440 strike price right here. If Tesla was literally at $440 flat, that is at the money. Now, how do you know if you're in the money, you're out of the money? Now, generally in the money, you're going to have a higher premium, right? If you're in the money, the value of the contract is going to be more than a contract that is out of the money for the same expiration date. Now, can you tell me and guess where that's going to be? Well, we can see that these contracts are higher priced than these contracts. Why is that? Well, because these call contracts by call are less or lower than the strike price. What does this mean? Well, this means this contract has more intrinsic value. And so what is that? That's kind of tossing you guys some terms here. It's nothing crazy to kind of explain. It's really that this contract, right, is just about $8 below the share price, which means there's $8 of intrinsic value. So, okay, this contract should be worth at least $8. Now, there's other things like implied volatility, which we'll talk about, time, and a bunch of other factors that go into it to make this price $56.85 that we're seeing right here. But the further you go down, we start adding $10 more of intrinsic value, and we start seeing that the price goes up. Now, of course, there's always volatility and time factors here that you're going to have to account for that are always changing, and for every single option, they're going to be slightly different, which is why we don't see a perfect correlation between, hey, this is a $10 difference in strike. Why isn't this premium $10 different? Well, because Tesla is extremely volatile, and there's a lot of other factors at play here. Now, for calls, in the money means that your price, your share price, your underlying share price, is above the strike price that you're looking at. So these are in the money, and now these would be out of the money because the share price is below the strike price. So these are out of the money versus in the money when it comes to calls. Now for puts, it's different. So click buy, put. Now we're looking at the same kind of thing here, except it's the opposite. It's just the reverse. If you're buying a put, you want Tesla's price to be below your strike price. That is going to make you more money. The further it falls below, the more money you're going to make. And if Tesla's price is higher than the strike price, well, that's going to have less value. And we can see that here, where we see the premium prices are going down as we move on down, and the premium prices go up as we move up because these contracts have a higher intrinsic value. Now, the next step here is time and volatility. These are your biggest battles when it comes to options trading, and it's not even close. Here's why I think this is the most challenging aspect for most traders. When you start looking into trading stocks, you start learning technical analysis or fundamental analysis and things like that, and you're really playing solid companies, or you're playing, companies that have catalysts, that have, a lot of hype around them, that are, running up, that are getting a lot of attention, or breaking out of, let's say, a resistance level or a downtrend or something like that. I don't want to say it's easy to predict the price action, but many times you'll see that you can predict the price action more often than not. However, the issue becomes, can you predict that in the correct time frame to make you the most money? That is where things get challenging. But I will say that time and volatility both have positive correlations to the option premium. So the more volatile the stock, the higher the option premium is going to be generally, and the more time you have until the expiration, the higher. So we're looking at puts, right? So let's take a look. We see these 60s right around 440 and 430. We're seeing 67 and 61. If I shorten this down to, let's say, like October 30th, okay, we're coming in, we have more, we can come and look at the same type of area. We're talking about, premiums in the 40s and 30s. So that's what I'm saying, is that the more time you put out in front, the higher the price is going to be, because again, there is more time for the stock to move in either direction, so there's potentially a higher chance that you could be in the money. So that's pretty much it for the intro. Now let's go through actually buying a call, and we'll do the same thing with the put here, but let's explain how to buy a call. So Tesla's price is moving around a little bit. Let's say we want to buy the 450 contract, right, calls, and let's bring this down to like on October 16th, the time I'm filming this video, just so the prices are a little bit lower, so it's a little bit more understandable and manageable and nothing crazy. But let's say, like I was looking at, let's say we want to buy these 450s. They're trading at $6.68. Now it's pre-market, so things are a little bit, they're not as fluid, but we'll open this up and we'll see. So I want to confirm what these things mean to break even percent change, things like that, because that can get very, very confusing, especially for people who are beginners, and I've gotten tons of questions on previous videos as to what this actually means. The first thing to note here is the bid and the ask that you can see right here. So this is just like any other stock. When you're trading stocks, there's a bid, there's an ask. So the bid is where the buyers are stacking up, the ask is where the sellers are stacking up. And so obviously we have the buyers here, we have the sellers here, so somewhere in the middle is where, you kind of have Robinhood putting that price. So Robinhood has a price right here of $6.68. So that's in the middle. When putting this order through, if you want to get filled right away and you're looking to buy this, put your order close to the ask or at the ask, and I can guarantee you're going to get filled. If you don't and you want to make sure you get in at a lower price, put your order at the bid, and as things are moving and as things are changing, you may get filled. But if the stock starts moving up or the contract price starts moving on up, because the contract price could move up without the stock moving up if there's a higher demand for it at a certain time. For example, there's lots of different trading groups and trading kind of teams or whatever who have a lot of people who may be buying a specific contract all at once, and that can really inflate the option premium even if the stock is just sitting still or even going down. So it's all about supply and demand. Now what you also want to look at is the volume and open interest. Now if you're looking at the volume and you're looking at the open interest here, this is actually pretty important. So if you're looking at a stock that's not Tesla, you're looking at like some stock that maybe isn't talked about. Maybe it's like a very low price stock, a $10 stock, a $5 stock, and you're not seeing, very much open interest or volume, and you're seeing like single digit numbers, that's not a good sign. That's showing you that if you bought these contracts, is it liquid enough for you to be able to get out? It may be tough, and you may have to sacrifice price to get out at a certain price. That's something you do want to understand. Before you ever buy a contract, always look to the volume and open interest that we see here. Then there's some more advanced things. There's the Greeks, there's the implied volatility like I mentioned before. So what you do want to understand is that you can look up other videos on this. This is going to get too complicated for this, but these are important as you kind of progress in your options trading. But for the purpose of a beginner video like this explaining how this works, these are a little bit too advanced. Now let's say I wanted to go ahead and buy this contract. So what I'm going to do is I'm going to click on the price right here. I'm going to have Robinhood pop this up, say I'm going to go long a call, which is I'm buying a call, and it is a 450 at 668. As of right now, we'll be able to go through and actually put in our amount of contracts. So we put in one contract right here, and one thing to note here is that once I put these contracts in, then I can set my limit price, and I have this good for a day. So I'll explain this right here really quick. So again, like we saw, we had the bid here at 650, ask at 685. That's what we see, this little range. If I want to get filled right away, I'll put this closer to 685. If there's enough volume, good chances I'll be able to get filled somewhere in between. Although if you are not, or if the stock starts moving on up, you may have to go back and edit this order and up the price to make sure you get filled if you want to get filled quickly. Then you see this max cost, okay? And so you're starting to see, what does this mean? If you're putting a limit price here at 670, you're going to get filled at that price or better. So it's going to be that price or lower. So you're not going to pay more than that. That's why they have this max cost. Now, also expires good for a day, which means that it's going to be expiring by the end of the day. If you click on this and you want to change it to good till canceled, this means it will expire in 90 days. So if it doesn't fill today, it could fill tomorrow, the next day, and it can fill in the next 90 days. But it can only fill, of course, in market hours. So from 9:30 a.m. Eastern to 4 p.m. Eastern is the only time of day that it could possibly fill. Now you may ask, why is it $670? Well, you have to understand that you're buying the option to buy 100 shares of Tesla stock at the strike price. This strike price we're looking at here is $450. These contracts, you're paying a max cost of $670, and for 100 shares, you have to multiply this by 100, which comes to your $670. So always understand, when you have one contract, take the limit price or the price of the option premium, which you're going to see right here, multiply that by 100, and that is the actual cost out of your pocket or out of your account that you're going to need to buy this. But now you can start to see the power here that if Tesla starts moving on up and this contract goes to $7, $8, $9, right? You can make a couple $100 in a fairly short period of time. And since Tesla can move 10, 20, 30, 50 points in a day because it's a very volatile stock, that is certainly possible if you can predict the correct move. Now, really quickly to the put side, so it's very, very similar. It's the same exact thing here for Tesla. So if we look to puts for the same exact thing, now I can look to, let's say I want to go for a 430 put. I can go in here, I can click on that. Again, I would just want to make sure that I come in here, see that there's open interest, there's volume, there's a decent amount. So if I'm only looking to get one contract, this is fine. But if I was somebody and there's only maybe 30 volume or 30 open interest, and I was looking to buy 10 contracts, that's something to be careful of and just understand that, hey, maybe either this is out very far in the future and not many people are interested in this contract right now, or maybe that's not the best contract to buy because I know that I may not be able to get out, and there may not be someone I can sell this contract to because there's no interest in it. So pretty much the same exact thing for the put side. I want to get one contract, and this is the right to sell 100 shares of Tesla stock here at the strike price of $430 that I'm looking at right here. And it's going to cost me $18.15, again, times 100, which puts me at $1,815 for this contract. Now, Tesla's contracts are pretty expensive if you were to go to a different stock. Let me just pull up one really quick. We're now looking at AT&T stock, ticker symbol T. This is a completely different game, although AT&T isn't as volatile and it does not move as much as Tesla. So these are going to be extremely cheap. Now, if you do anticipate a move in AT&T, or maybe you want to play a longer term play in AT&T, take a look at this. The stock price is at $28.30. Let's say I want to buy a call, and I'm going to buy this call at $28.50 for 30 cents. Now we go through here and we say, okay, I want to buy one contract. One contract at 30 cents is only going to cost me $30. And so this is how you can get started with options with a very, very small account. And just to double check, we go look at the volume, we see open interest, and we see that there is plenty. And so we know that this is a liquid play and we are able to get out of this play if we ever need to. So that is great for AT&T, and if you wanted to buy this contract, you can certainly go ahead and do so for only $30. So like I mentioned before, I have other videos on the channel that you can go to and I can explain how to sell calls and puts. But pretty much the cool thing about selling calls and puts, and why I would say this is probably a really cool way to kind of make some money, is to sell some covered calls. And it's an example I did before. Now, to sell a covered call, you'd have to have 100 shares of the stock. But let's say you hold AT&T, it's paying you a dividend, or let's say you're holding Apple stock. What you can do is you can sell, let's say, a call for $29. And if AT&T never gets to, $29 by the 9th, this is going to expire worthless, as this will be out of the money. If the contract expires out of the money, it expires at zero. It's going to expire worthless. And so that's the real risk when it comes to options trading. But selling calls, as a quick little kind of synopsis of how it works, is I can sell, let's say, a 29 call here for AT&T. I can get paid $3, okay? Because this is, of course, 3 cents. Now you have to multiply by 100 for 100 shares. I'm going to get paid $3 if I sell it for 3 cents. And guess what? AT&T probably will not hit $29 by the end of this week, which is with the expiration date here, because it's Wednesday. It'd have to move up pretty significantly. And if it doesn't hit $29, or it's not over $29, I keep my 100 shares of AT&T, and I got paid $3 to do so, to sell that call. So that's briefly how it works. Look up how to sell covered calls on my channel, and you'll find a better explanation of how this works and how it was actually pretty profitable and how it's very cool to do longer term. Now, one other thing to note here is I want to explain this. We're seeing these numbers right in here, and this is what people always get confused on. So this is going to be your change on the day, and so of course today the market hasn't opened yet. We're 15 minutes out from the open, so it's not really doing anything. But to break even on this contract, this is going to show you this number, and the chance of profit is going to tell you this right here. I want to explain what that means. That's very confusing to a lot of folks because they don't know. They think, okay, to break even, AT&T is going to have to go to $28.80 to get my 30 cents back, or $30 in this case, if you multiply by 100 per contract. Now, that is actually confusing because this is going off of at the expiration, okay? This is talking about the intrinsic value. So this stock needs to be at $28.80 to have 30 cents of intrinsic value come the expiration for you to break even on the contract. However, you have to factor in time and volatility. If AT&T starts moving up because you're buying a call, let me go back to the buying side, because you're buying a call here, if AT&T starts moving up today and tomorrow, and let's say it's Wednesday and Thursday, and let's say Friday is the expiration, this is going to be higher in value because AT&T also has time and volatility for it to also factor into the price. So I know this is confusing, but I'm going to try to kind of simplify and explain it as best as I can. Hopefully this is making some sense. Know that when there's intrinsic value, okay, you have to understand there's intrinsic value here of this option as long as AT&T's share price is above the strike price for buying a call. Opposite for puts. We see the share price right now of $28.35. Currently, this would be expiring out of the money as this contract is above this current price. So technically, AT&T right now has no intrinsic value because it is out of the money. AT&T would need to be 30 cents above this price, above this strike price by the expiration date for it to have intrinsic value of 30 cents, and that is where this is coming from. That's where that break even is coming from. But if you're someone who is going to be trading the volatility in the intraday kind of movement, this could happen where you might buy this for 30 cents today. Or maybe today it's 20 cents when the market opens. And it may go to 25 cents to 30 cents. It may make a move of 5 to 10 cents in a short period of time, which would be a significant percentage gain for you, and then you could sell that intraday, or maybe you want to sell it tomorrow and it's up a couple cents, even though it's technically not even at the break even because there's still time for that expiration date to hit in a day or two. So hopefully that makes some sense, and it's the opposite for puts. If you have any questions, leave them down below, but that's something that you want to make sure you understand, so don't worry too much about this number. Just know that's intrinsic value. Yeah, that's what it has to be. People get caught up in the break even and the percent to break even. Don't worry about that. What you should be more concerned about is getting and predicting that price movement in a short period of time for you to buy and sell the premium for a profit. So like I said, this is extremely risky, especially if you're playing with a lot of money or you're playing with a large amount of money that you are not willing to lose because, like I said, if you're holding this until the expiration date and AT&T stock does not get to $28.50 by the end of the week, this option is going to go down in value significantly. Now, again, if you're playing with 30 bucks and that's not much money to you and you're just trying to learn, that's fine. But if you start buying 20, 30, 100 contracts of AT&T and that's your entire account because you just started up your account with a couple $100 or a couple $1,000 and you lose it all, that's the risk that you're taking here. Just know I've learned this the hard way myself, and so I'm kind of speaking from experience. So my strategy right now for options, and you don't have to follow this, everyone's going to have their own strategy. My strategy is I mostly will day trade them, and if I swing trade them, I'm anticipating a significant move, and I'm willing to take that risk, and I'm going in with a small position size. If I'm going to day trade them, I may buy AT&T stock, I may buy it at 30 cents, and I'm looking for a quick move to 35 cents on that contract. I'm getting in, I'm getting out, and that is it. I'm not holding overnight because, again, if you hold overnight, there's some negative news, there's some massive macroeconomic kind of news or landscape that you're in, and things drop or things go the opposite way than you're predicting. If you're buying a call and all of a sudden, the whole stock market's down the next day because you held overnight and there's some crazy news out, or you're buying a put and all of a sudden, there's some mega, stimulus news and the market goes up, you want to be careful of that. Know those risks of holding overnight. That's why for me, options plays, because time is kind of against you, I would like to day trade them. If I'm just buying and selling shares of a stock, yes, you can have those overnight fluctuations based on the overall market, but I know longer term, I don't have to worry about someone putting a little stopwatch next to me saying, you only have 3 days left until it expires. I know, hey, I'm going to hold this stock. I don't know when the move's coming, but I know we're set up for a breakout, or I like this company. I like, what's going on, like the fundamentals driving it. So in the next couple of weeks or months, I'm anticipating a move up, and I'm willing to hold this stock through the ups and downs temporarily for that bigger move. So that's just me. That's my strategy. Again, if you have any questions, make sure to leave them down below and check out the other videos here on the channel talking about selling options if that's something you're interested in learning how to do. It could be a great way to earn a couple extra bucks on stocks you're already holding. Hopefully you guys enjoyed this video. Hopefully it helped you out. Please hit the thumbs up button if it did. I appreciate every single one of you. If you're not already subscribed, subscribe to the channel and hit those links down below to get those free stocks on Robinhood, other platforms, and any resources that you want to take advantage of. Those are linked down below because they have helped me in the past and I want to share them. Again, I appreciate every single one of you guys, and I will see you in the next one. Peace.